Hey guys, I figured I will peek at what Lacey Hunt has been saying. I love looking at his face. I hate to do one where I can't see his face at all. But I just let's look at this one. See what it
Tremendous
says.
helps you send rewards people will love.
Data, the jobs data, the services data, the equity market ignored the bad news and went with the soft landing scenario. The bond market saw the data as an end of the Fed tightening and a break in the clouds for the bond bulls. Would you agree that there is a break in the cloud for the bond bulls?
I would say the cloud is breaking because the economy is heading into a hard landing. It's a process that will take time. The U.S. economy has very serious difficulties. Difficulties going to be with us for a long time in the future.
That hard landing, when we last caught up with you, if I look at M2, and I know that you're an advocate of ODL, other deposits and liabilities, but M2, according to the St. Louis Fed, is negative for the first time in nearly 70 years. Is that going to cause a much harder landing, perhaps, than the market presumes right now when you look at bond yields at 4.5%?
Well, several years ago, I rewrote Friedman's great paper to the American Economic Review on theory of interest rates. And Friedman said monetary decelerations lead to lower interest rates. I adjusted his theory to say that monetary decelerations lead to lower interest rates unless the velocity of money rises. Now, we have a very serious monetary contraction in real dollars, which is the way I prefer to look at it. If you look at my preferred measure, ODL, it has declined in real terms over the last 12, 24, and 36-month intervals. And although velocity has risen slightly over the last 2 years, I believe the velocity is in the process of making a move to the lower side over the course of the next year. And this will greatly complicate the Fed's ability for monetary policy to work when they do decide to lower interest rates. There's an old phrase that when the Fed tries to stimulate there, it's like pushing on the string. In this particular case, the pushing on the string will be even more difficult than normal for the Fed. The Fed's capabilities will be very asymmetric when they need the economy's support, which I suspect they are going to need quite significantly in the next couple of years.
Well, I think their job's going to be even more difficult next year when they've promised a higher for longer narrative. If it is a hard landing, as you say, they're going to be less tax receipts in the Treasury. The normal reaction functions will be much less, which again raises the spectre that the bond vigilantes will re-attack the bond market rather than perhaps people buying bonds and getting those yields down. The risk is really that higher for longer narrative in a lower growth scenario is a big risk for the bond markets.
Well, there clearly is a lot of negative psychology there. We absolutely remiss if I didn't acknowledge that. But I think that when viewed in its totality, the federal fiscal mess that the country is in right now is going to be a constraint on growth and produce less inflation. The United States has a very unique situation right now. In the second quarter, which is the latest numbers we have negative net national saving, which means that the government is saving is more than absorbing all of the private saving and the net foreign saving. But when we go into the recession, the net negative saving will be even greater. One of the great truths of economics is that physical investment must equal net national saving. Otherwise, you cannot get an increase in the capital stock. And we're going to have a severe shortage of saving, which means that we will not have funds to expand the capital stock. This will undermine the rate of economic growth, and it will create very, very poor economic conditions. And those conditions will reinforce the unfolding disinflationary pressures that are emerging in the United States, and bond yields will work lower in spite of the fact that the budget deficit will be quite large, unprecedentedly large, for an economic recession and its immediate aftermath.
Let's just update where we are. It's been 2 brutal years for the bond markets, given the scenario that you're outlining that's coming through in 2024. Do you think that yields will fall much further in 2023? Can the bond market rout be salvaged this year before the close of business?
I believe that they will reverse a lot. When the pandemic hit, the U.S. and the global economy had certain basic problems. First of all, the United States and all the major economies of the world were extremely over-indebted. This indebtedness is triggering the law of diminishing returns, which means that it's undermining economic growth. The world had extremely poor demographics. Mm-hmm. And finally, there was no one in the world that could provide economic leadership. And all those problems are now far more worse than they were when the pandemic hit. The indebtedness situation is far worse. The demographics have deteriorated in the United States, Europe, Japan, and China. China has horrible demographics. In my view, demographics is destiny. You need growing economies, you need young economies with a high birth. None of the 4 major economies do. And given the fact that there has been this unprecedented degree of monetary restraint, the problem for the U.S. and the rest of the world is that there's going to be very poor growth, very erratic growth, but the inflationary problem, in my view, for all practical purposes, has already been solved.
Okay, so that builds the case then for lower yields. Where will the bond market take itself to next year on that thesis you've just put out?
All I can tell you is that our company has a 18-year duration, which is a statement that we believe that there are considerable opportunities. The SEC doesn't allow me to give rate predictions anymore, but the 18-year duration, I think, speaks for itself.
So if the position on the curve, would you, I just want to understand, if we look at the curve, the position on the curve, assuming your duration weighted yield position, is 18 years the optimal position, or do you think coming down the curve is where there may be a bigger yield uplift?
The yields what we're going to see, we're beginning to see it now, is the yield curve will normalize. The short yields will drop more rapidly than the long yields, but the greatest capital gains opportunities will be in the longer end of the curve.
Do you think more term premium? Do you see that expanding further? We've talked a lot about it in the past 3, 4, 5 weeks. There's been quite a move in term premium. Do you think that term premium increases from here?
I think the main thing that I would focus on is that we're going to see the degree of inflationary expectations fall very dramatically, and probably back to the levels that existed prior to the pandemic, somewhere in the 2% range, as opposed to being above 3 now. And I think when economic conditions weaken, investors will see that there is great advantage in holding the long duration treasuries.
The theory the market has latched on to is, and it's doing battle royal with the Fed, let's see what Powell has to say and the other Fed speakers this week, is that you're going to get 100 basis points of cuts next year. With what we've just discussed, is that a right number of cuts, 100 basis points, or do you think that they will be forced to do more given the economic scenario you've just outlined?
I think that it's really, from my perspective, I don't think it's necessary for me to.
Hey, entrepreneurs and business owners, you got to try the
amount of cuts that the Federal Reserve will cut. They will cut the rate, but unfortunately, the net national saving will remain negative and a constraint on growth long after the Federal Reserve cuts the rates. Also keep in mind that the rate cuts will be in the cyclical fashion. The economy will decline sector by sector, and as the Fed moves slowly, so will the economy. And I think that the Fed will remain behind the curve, just as they remained behind the inflationary curve in 2020 and 2021.
Let me just turn to the October 19th statement by Jay Powell. The path we're on is unsustainable, and we'll have to get off that path sooner rather than later. Of course, Powell was referring to the fiscal position in his statement. The risk is this, of course, that the fiscal situation is tough, as you've just outlined, and that is what I put to you will perhaps stand as a roadblock to the drop in yield that you ascribe to, which is that there is this fiscal largesse. The Treasury is printing money to pay off the government debt interest, the interest on the debt. So we have this conundrum. Powell is warning, or is it a cry for help on the fiscal front?
Well, the fiscal side is in extreme disarray, but I've done extensive work on the government expenditure multiplier, and contrary to the simplistic notions that were taught over the last several decades, I believe that the government multiplier is actually negative, not positive. That when you engage in deficit spending, such as we did in 2020 and 21, that has a transitory boost to economic activity for 4 to 6 quarters. But after 4 to 6 quarters, the multiplier becomes negative. And so as a consequence, the deficit will actually serve as a millstone around the economy. Another problem that we have is that, by my calculation, there is approximately $1.2 trillion of debt that was issued in 2020 and 2021, very low rates, that will mature in 2024. And so what will happen is we will see a huge diversion of the income stream from those investments a few years ago into interest payments. And there is nothing more unproductive than using a cash stream to allocate it to interest expense. And this will serve to contract economic activity, and it will in fact mean that fiscal policy will be undermining economic growth, just in the same way as the restrictive monetary policy that we've seen from the fourth quarter of 2021. So fiscal policy is not helpful now. It will not be helpful in the years to come. And I do not see a replay of the monetary and fiscal coordination that we saw in 2020 and 2021. It proved to be a disastrous consequence. It resulted in the inflation, and the inflation had horrific results for the vast majority of our people. Indeed. The average earnings have declined at by 2.5% in the last 3 quarters, even though the GDP was dropping, and we saw a drop in median household income in each of the last 3 years back to the 2018 levels. So the policy response of the pandemic is not the policy response that we will see going forward. And in the period going forward, we're going to pay the price of the excessive monetary and fiscal largesse that was initiated during the pandemic in 2020 and 2021.
Dr. Lacy Hunt, thank you very much for being with us on Bloomberg.
Josh Jelinski, Bean Financial. I live, it doesn't seem like there's any building. It seems like there's a dearth of housing. Now, maybe our particular spot.
I want to distinguish, in the single family market will recover. My problem is not the single family.
Okay, it's multifamily because they use
the
cheap money.
The multifamily sector is the one where I see the difficulty.
I agree with that 100%, yeah.
I think that the rents are coming down from the big firms that survey this. I think one of the series that I've seen, which has been pretty reliable, shows that rents are now down in the 3 to 4% range from a year ago. And that's where the delinquencies are. We've overbuilt one of the areas that probably received more of the excess liquidity in 2020 and 2021 was the multifamily sector, and that's the one that's the most vulnerable.
Yeah, definitely. I remember in 2020, people would say, "Oh, you want to get rich quick? Become a multifamily landlord." And
a big realty firm that collect information and the weakness in rents. Also, if you look at if you Google foreclosures of multifamily apartments that have been taking place, some of those articles have fairly good descriptions of the problem, the general overcapacity, the fact that a lot of projects were financed at very, very low rates. They had 2 or 3 year financing on really a long-term investment. So those loans have to now be refinanced. The cap rates were very low then, which means you could borrow a substantial amount of what you had invested in the project. Now the cap rates are considerably higher, and so you cannot borrow as much against the property. A lot of people went in with very thin equity, and because it was considered such a sure thing, just as you said, and I think there's going to be quite a fallout in that sector as we go through the year.
definitely. So just Google multifamily foreclosures, and I should see some stuff. I saw the Reddit data.
There have been several projects that have gone on, and there will be more.
But who do you trust? Like when you look at data, generally Redfin.
Well, you can also look at the house figures and go to look at the multifamily versus the single family, and look at the amount of the multifamily construction that took place over the last 3 years. Been extremely high, and it was really outside what the demographics require, and that's a key fundamental element in my forecast for that sector.
So let's go to commercial real estate. I'm kind of worried about the same thing in multifamily for commercial.
I look at the Moody's office vacancy rate, which is the lowest now since the 1990s. There's a very, very substantial oversupply of office space. And I think that that sector will be weak not only in 2024, but for several years. We're going to have a long-term workout situation here in the office sector.
What do you think will precipitate its increase again? I mean, COVID, obviously 2020, low rates, people buying commercial buildings in 2020 before the sort of COVID meltdown. That makes sense. Almost the same theory behind the multifamily boom and then bust. People aren't returning to work. I'm seeing places like Regis and IWG. They're even retooling workspaces so people, for $300, they get a room. Or for $1,200, they get an office. So they're kind of changing the way people go to work now. Is it just people aren't renting 5,000 square feet buildings anymore?
Well, also keep in mind that if you look outside of your high multiplier sector, which would be the big ticket items, both the business and the consumer sector, international trade, in the last 3 months, we've had only an average of 100,000 gain in employment a month, and those are all in very staid, low multiplier sectors. And so there's just not the demand for office space at the present time. And I think we're going to continue to see further weakness in the labor markets. And so the oversupply that we see today is not ultimately going to, it's lower now than it will go lower as the year progresses. as the labor markets continue to weaken.
Anything else on the commercial real estate front?
In the commercial sector, you have the same problem you do in the multifamily construction. There was a lot of interim financing that was arranged at very, very low rates, which allowed construction to go forward at a very substantial pace. And now that short-term financing is no longer available. And also the credit quality of the borrowers has deteriorated. So the likelihood of a replication of that is not in the cards, and we're going to have to work off those excess supplies that were created.